Welcome back to the Community Corner podcast, where we explore the companies in the S500 through the lens of behavioral finance. I'm Arnav.
And I'm Nikhil. Today, we're turning our focus to Wells Fargo Co., one of the largest and oldest financial institutions in the United States, known for its extensive network of retail banking branches and wide range of financial services. We'll be discussing how behavioral finance impacts their decision-making, diversity and inclusion efforts, adaptation to different markets, and how they compare to other companies in the industry. Let's dive in.
Wells Fargo has a long history in the banking industry, but from a behavioral finance perspective, how do biases like loss aversion and the status quo bias influence their decision-making, especially in areas like risk management and customer relationships?
Loss aversion is a significant factor in Wells Fargo's decision-making, particularly given its recent history of regulatory issues and scandals. The company has been very focused on risk management and rebuilding trust with customers and regulators. This aversion to further losses has led Wells Fargo to adopt a more conservative approach to its operations, prioritizing compliance, customer satisfaction, and risk mitigation over aggressive growth strategies. The status quo bias also plays a crucial role in Wells Fargo's approach to customer relationships. The bank has historically relied on its vast branch network and strong customer service to maintain customer loyalty. This bias towards maintaining established practices has helped Wells Fargo retain a large customer base, but it has also slowed down the bank's adaptation to digital banking trends, where competitors like JP Morgan Chase and Bank of America have taken the lead.
And this focus on loss aversion and maintaining the status quo has helped Wells Fargo stabilize after its challenges, appealing to both customers and investors who prioritize security and reliability.
Exactly. Wells Fargo's strategic use of loss aversion and the status quo bias appeals to investors looking for a stable and conservative investment in the financial sector. However, this approach also means that Wells Fargo must carefully balance the need to innovate and adapt to changing market conditions while maintaining the trust and confidence it has worked to rebuild.
Let's talk about diversity, equity, and inclusion at Wells Fargo. As one of the largest banks in the U.S., DEI is particularly important for Wells Fargo. How does this intersect with behavioral finance?
Wells Fargo's approach to DEI is critical, especially as the company seeks to rebuild its reputation and regain the trust of both customers and employees. From a behavioral finance perspective, strong DEI initiatives can enhance the bank's ability to connect with a diverse customer base and foster a more inclusive work environment. A commitment to DEI can lead to better decision-making, as diverse teams are more likely to consider a wider range of perspectives and potential outcomes. For investors, Wells Fargo's focus on DEI can signal that the company is taking meaningful steps to align with societal values and address past shortcomings, which can enhance its reputation and appeal to ESG-focused investors. Additionally, DEI efforts can help Wells Fargo attract and retain top talent, which is essential for maintaining its competitive edge in the financial services industry.
Investors are increasingly considering DEI when evaluating companies, especially in finance, where trust and reputation are vital to long-term success.
That's right. By embedding DEI into their corporate culture, Wells Fargo not only improves its ability to serve a broad range of customers but also strengthens its market position and attractiveness to socially conscious investors.
Moving on to their market strategy, Wells Fargo operates primarily in the U.S., but it has a significant presence in other regions as well. How does the company adapt to different markets, and what role does behavioral finance play in this?
Wells Fargo's strategy focuses heavily on its U.S. operations, particularly in retail and commercial banking. However, the bank also has a presence in international markets, primarily through its wholesale banking services. From a behavioral finance perspective, this focus on domestic markets can be seen as a form of home bias, where the company prioritizes familiar markets where it has a strong historical presence. This approach helps Wells Fargo manage risks associated with operating in diverse regulatory environments and economic conditions. However, it also means that the bank may miss out in rapidly growing international markets where competitors are expanding more aggressively. By maintaining a conservative approach to global expansion, Wells Fargo can better control risks, but it may also limit its growth potential in the long term.
And this conservative approach is especially important for Wells Fargo, given the regulatory scrutiny it has faced in recent years. Their ability to manage risks effectively and maintain strong customer relationships in their core markets is key to their continued success.
Exactly. Wells Fargo's focus on risk management and maintaining its core strengths allows the bank to remain a significant player in the U.S. financial sector while carefully navigating the challenges of international expansion. However, this also requires the bank to be proactive in responding to changes in the global economy and regulatory landscape.
Now, let's compare Wells Fargo to other companies in the financial industry like JP Morgan Chase, Citigroup, and Bank of America. How do the behavioral finance dynamics differ?
Wells Fargo's dynamics are often compared to other banking giants like JP Morgan Chase, Citigroup, and Bank of America, particularly in their approach to risk management, customer service, and market strategy. Wells Fargo's emphasis on customer relationships and its extensive branch network appeals to investors who value a more traditional, relationship-driven banking model. JP Morgan Chase, with its strong investment banking division and focus on digital innovation, appeals to investors looking for a more aggressive growth strategy. Citigroup, with its global reach and focus on international markets, appeals to those interested in exposure to global financial markets. Bank of America, with its balance of retail banking, wealth management, and digital services, offers a different kind of stability and innovation. Wells Fargo's behavioral finance dynamics are shaped by its reputation for customer service, risk management, and a focus on its core domestic market, making it an attractive option for those seeking stability in the financial sector.
And unlike JP Morgan Chase, which has a strong focus on investment banking and digital transformation, Wells Fargo's strength lies in its customer-centric approach and extensive branch network, appealing to a different type of investor and customer.
Absolutely. Each of these companies has its own behavioral finance dynamics that influence how investors perceive their value and potential risks. For Wells Fargo, the focus on customer relationships, risk management, and a strong domestic presence provides a unique value proposition in the financial services industry.
To sum up, Wells Fargo's approach to business is deeply influenced by behavioral finance principles, whether it's through their risk management strategies, market focus, or their approach to DEI. But like all companies, they are still subject to the biases and perceptions that can influence investor behavior.
That's right. Understanding these dynamics provides a clearer picture of what drives Wells Fargo's stock price and where the potential risks and rewards lie.
Thanks for joining us on this episode of the Community Corner podcast. Until next time, I'm Arnav.
And I'm Nikhil. Stay curious and keep questioning the narratives.